One of the most accurate forecasters around on bank stocks says it is time to buy. Chris Kotowski is a senior analyst for large cap banks and brokers at Oppenheimer, and he's a Bloomberg best. So, Chris, you're recommending buying financials before earnings season begins. Specifically, what are you recommending?
Well, yeah, let me just say, in general, for the past year, roughly, we've been very bullish on bank stocks because, the history of bank stocks in each of the last 4 major recessions is that they tend to outperform for a couple of years after a big recession. And, we're clearly in a recovery mode, so our longer-term strategic view is that people should probably overweight bank stocks, for a couple of years here. Is historically how long they've done well. Now, shorter term, more tactically, bank stocks had a 16% run between Thanksgiving and New Year's Day, a time when usually nothing ever happens, and then they continued to run into January. So at the end of January, we had a short-term tactical call, and I rarely make shorter-term trading calls. But we had a short-term tactical call saying, wow, this rally has made our head spin a little bit. The stocks will probably mark time for a while. And they've done that. They've underperformed by a couple of hundred basis points in the last 2 months. And, my sense is still that we're in a recovery, and that when people look at the first quarter earnings prints, they're going to say, gee, the world isn't so bad. Non-performers are continuing to improve. We're getting dividend yields that are higher than the S&P on a lot of these stocks, and things are getting better.
And that's, but your top pick right now is Citi. What's your argument besides it being cheap?
Oh, well, Citi has a lot of good businesses. So Citi has corrected very sharply. It's down about 13% off its recent high, and it's trading right at tangible book. It's one of the few banks still out there that is trading near tangible book. And to my mind, Citibank, it's had its issues, but it's got some great businesses in there. It's got a great transaction services franchise. It has an investment bank that is actually a lot better than people give it credit. It has a good credit card business here in the United States, and it has nice businesses in Mexico, Brazil, and in Asia.
Well, one thing that jumped out at me in reading your report, and we pulled this quote because I thought it was a strong one. One of the reasons you like Citi is because they don't have much exposure to the mortgage business from your point of view. You said, in fact, a 30-year prepayable, fixed-rate, non-recourse loan right now is the most inherently toxic financial instrument ever developed.
Well, that's true. And if you go back to 1980, that instrument wiped out nearly the entire thrift industry. And then 30 years later, it wiped out Fannie and Freddie that were the main providers of it.
But you're still buying JP Morgan and Wells Fargo. They've got businesses in there.
Yeah, but again, for the most part, it's over the last 30 years, what's happened is that the ownership of those instruments has passed to Fannie and Freddie. Again, I don't like the business because it's inherently dependent on a government subsidy.
All right, Chris, thanks so much for giving us your point of view. Chris Kotowski of Oppenheimer, recommending financials, buying now.